Okay, welcome back from the afternoon break. And now we have the panel on FDII and BEAT, winners and losers. Among several radical changes made to the U.S. international tax legislation by the Tax Cuts and Jobs Act are the FDII, the Foreign-Derived Intangible Income provision, and the BEAT, the Base Erosion Anti-Abuse Tax. Proposed regulations were recently issued on both of those legislative provisions. Our panel today will provide insights and commentary concerning both the policy and the practical aspects of these provisions. The panel will be chaired by Deborah Paul, with panelists Peter Blessing and Michael Caballero. From your left, Deborah Paul is a partner in the tax department at Wachtell, Lipton, Rosen, and Katz, where she focuses on tax aspects of corporate transactions, including mergers and acquisitions, joint ventures, spin-offs, and financial instruments. Debbie is the current chair of the tax section at the New York State Bar Association. Peter Blessing is a member of the International M&A and Complex Transaction Groups in KPMG's Washington National Tax Practice. Peter was a former chair of the tax section of the New York State Bar Association, has taught as an adjunct professor at Columbia Law School, and most recently served as president of the USA branch of IFA. Michael Caballero is a partner in the Washington, D.C. office of Covington and Burling, and a vice chair of the firm's tax practice. Michael recently served as international tax counsel in the U.S. Treasury's Office of Tax Policy. Debbie.
Greetings. Well, we are very excited to be here today to talk to you about the BEAT and FDII. Larry has treated us to this image of a carnival game at an amusement park to get us started. And I was thinking about what the analogy is. You know, at a carnival game, you walk up, you try your chance at a game of luck or skill, and then you walk away. And I was thinking that's a little different maybe, especially from the BEAT, in the sense that with few exceptions, everybody is subject to the BEAT. And so instead of walking up, playing the game, and walking away, it's a little bit more like you're surrounded by carnival games. You're in a corral of carnival games, and you can't get out. You can go from one to the other, but as we're going to see when we talk about BEAT, there are corollaries within corollaries within corollaries, and the BEAT starts to seem like it's everywhere around you, and maybe you can't escape. With respect to FDII, with some luck and skill, maybe you do get to play, although maybe, as we'll find, it may be hard to find the FDII where you want it. So first, let's start with the BEAT, Section 59, capital A, the Base Erosion and Anti-Abuse Tax. This is a minimum tax calculated by adding back to your taxable income certain deductible payments made to a related party. The rate is generally 10%, but it's 5% for tax years beginning in the calendar year 2018. And it's, as I said, a minimum tax, 10% times this modified taxable income, and you compare that with your regular tax liability. Now, there's been a lot of interest in the BEAT because all large taxpayers, all large multinationals are basically subject to the BEAT. So Michael, can you talk to us about who is hurt by the BEAT and who is not hurt by the BEAT?
All right, thank you, Deborah. To start out, I think as everybody has already come to realize, everybody is hurt or at least affected by the BEAT, which is a little bit of a surprise. I think when most people think about base erosion, anti-abuse, the focus was, at least as a starting point, foreign multinationals with investments in the United States, but it's abundantly clear that this tax is hitting everybody. It's sort of interesting in its structure, as has been talked about earlier today. The exception for COGS means that manufacturers find themselves often a little bit less affected than otherwise, but industries that do not have COGS as a significant component. Services, financial industry feel the beat kind of most profoundly. Two things I would say sort of focus on where people seem to be hit the hardest or most unexpectedly. Again, U.S. multinationals, and the real driver there is the disallowance of the foreign tax credit. It's not really clear why foreign tax credits are disallowed as part of the BEAT. The disallowance is with respect to all foreign tax credits. It's unrelated to those foreign tax credits being related to payments to related parties. But it does mean that a tax which you would have thought at a minimum might have hit inbound taxation a little bit more seriously, or ideally might be neutral across U.S. and foreign multinationals. I think we've created a system that actually hits U.S. multinationals much more severely than inbound investors. The last thing, and this has been mentioned too before, are people with U.S. principal structures. And that's kind of code for basically anywhere you've got gross income coming into the U.S. and then that being paid out to a foreign affiliate. Service businesses are a classic example where there may be a contractual arrangement with a customer that's in the U.S., but then payments are being made both to U.S. affiliates and foreign affiliates wherever those services are being provided. The reality is this is another place where U.S. multinationals get hit harder because U.S. multinationals often have that customer relationship in the United States, whereas a foreign multinational, which may have the same geographic spread in the provision of services, nonetheless has the customer relationship outside the U.S. and is completely missed by the BEAT tax for that reason.
Let's say a couple of things about financial institutions. These are institutions that have flows in and out. There's no specific netting rule in the statute, so it leaves them in a precarious position. The second thing is the amounts of interest deductions on those on the payments of interest out are obviously central to their business. And 882-5 created several different alternatives that they could deduct interest. One is adjusted U.S. booked liabilities. Another is separate currency pool methods. And then under the treaty method, the authorized OECD approach. And these yield vastly different results. And it doesn't make any sense at all for BEAT to have vastly different results in these situations. They also have the problem of TLAC type of regulatory capital coming in, which is required to run through the system. You can't just say, oh, let's just restructure and pay directly to a foreign party. And the proposed regs, they have an exception, but it's only for TLAC that's issued by a U.S. international holding company. So it's only for one out of a whole number of different situations of which can come up, but most prominent of which is internal foreign to foreign total loss absorbing securities. And another example, I guess, is the global dealing regs, which are an authorized, long-established regime, and which one thinks of as much like a partnership, and yet there's been no clarification that the payments made to one participant there are owned by that participant rather than a deduction by a party and paid to that recipient. And these things just all have to be clarified.
Yeah. So as we've said, the basic concept of BEAT is where a U.S. person pays a deductible payment to a foreign related person that's added back to figure out your modified taxable income for BEAT purposes. There's a corollary to that in the statute, which is that if the U.S. person buys property from a foreign related person and that property is depreciable or amortizable, that outbound payment as well is, as people say, beatable. It's meant to be added back. So that's a corollary of the basic premise, and that is in the statute. Now, the proposed regs have then taken that a step further and said that if depreciable assets come from foreign-related person into the United States in a non-recognition transaction, like a inbound 332 liquidation or inbound asset reorganization or an inbound 351, there's a payment for BEAT purposes, whatever consideration was delivered, that has to be added back. And by the same token, if there's a taxable acquisition of a depreciable asset, but the U.S. person is paying with stock, that too is subject to the BEAT. However, if a CFC distributes a depreciable asset under Section 301 to U.S. parent, that's not subject to the BEAT because there's nothing that the U.S. person is paying or can be deemed to pay for that asset. So, Michael, does this make sense? Are these the kinds of transactions that should be subject to the BEAT?
I think making sense is a really good question. It's one that you find yourself asking every time when you're in the world of BEAT. And the standard of what makes sense in the BEAT is a little bit different, I think, than outside of the BEAT. But when you first start out, I think one of the questions is people have approached this as a policy matter. A lot of people have been making 332 liquidations to get around BEAT, bring assets onto the U.S. tax return. It seems like if you put everything in the U.S., you shouldn't have a base erosion problem. And yet, obviously, this has been at least a significant detriment to people who've completed those transactions and a real impediment for people who think about doing them. For me, the biggest problem here is the underlying principle, the sense that if you buy a depreciable asset, somehow that's a base eroding payment. I just don't think that's the right way to think about things. You know, when you think about the treaties, which have been around for a very long time and have focused on base erosion payments, fair market value purchases of property or services have always been excluded as base eroding payments because, in fact, they really aren't base eroding. And when you think about where this puts companies, right, if you're a company, and not to pick a particular company, but if you're General Electric and you buy a light bulb from an affiliate, that is a BEAT payment, as it turns out. But if instead they light their offices in the US with Sylvania light bulbs, then they don't have a BEAT payment. And I throw that out there because one aspect of these rules are it really penalizes what would otherwise be normal behavior, purchasing, and in fact, behavior that you would expect purchasing from an affiliate. And carving it out is not something that we don't find out there in nature. For example, 956. If you lend to the US, it's a problem. Deposits are a problem if you put them with the US bank. But of course, if you're allowed to put them with an affiliate, if in fact that affiliate is in a banking business. The active financing exception. There are rules that require you to have unrelated customer transactions and such, but at the end of the day, related party transactions still qualify for exemption because the idea that Citibank would put its money on deposit with a different bank to avoid US taxation just doesn't make any sense. So for me, while the 332 is interesting, it's part of a bigger problem, and it also then turns into a question I think the government's facing a lot, which is, do we achieve parity between, for example, a taxable acquisition of depreciable property, which is unquestionably covered under the statute, even if it seems misguided, or do you try and use your regulatory authority and at least minimize the damage and say, I may have disparate results on similar transactions, but I should be doing what I can to make the BEAT as workable as possible. I don't know.
Yeah. On this one, the non-recognition trade, I mean, the big conceptual issue is you're bringing in income-producing assets. In fact, you're doing what Congress thought was a good thing, and they actually had a provision to encourage that for a while in the statute. To me, it doesn't make a lot of sense if you're importing income-producing assets that's somehow creates a BEAT issue.
Yeah.
I'll just finish a couple things. It's also just a mere change in form. You're not, if you look at the statutory language, you're not paying or accruing by taking back an interest in an entity. In fact, I agree with Michael that the Congress in its wisdom did decide that payment for depreciable property should be covered, but Treasury and IRS in their wisdom can decide that this is not literally a payment for depreciable property, and it's a bridge too far to extend.
Yeah, so on the one hand, if you think about classic base eroding payments, what you think about typically are interest payments to a foreign related party and royalty payments to a foreign related party. Those are the kinds of things people tend to think of as the paradigmatic type of base eroding payments. So in the statute, Congress said, well, what is that model really about? It's about a payment going out from the US to foreign, and the US person getting a deduction somehow in connection with that payment. And so they said, well, thinking just sort of one level over, let's think about a purchase of depreciable property. That sounds like it fits within the model. Payment for the depreciable property, and lo and behold, although the payment itself is not deductible, the property yields deductions in the form of depreciation or amortization. So they said, let's cover that too. And at that abstract level, it sort of sounds like it makes sense. But then Michael says, well, wait a minute, that means that if a company that manufactures light bulbs buys them from its affiliate, all of a sudden that's a beatable payment, and that seems strange. And then Peter says it seems even stranger that an inbound liquidation, for example, should be considered subject to the BEAT. And by the way, how is this base eroding when in fact what we're doing in these asset reorgs, or inbound liquidations, or 351s, well, we may not be a light bulb, it may be equipment. And what we're doing is bringing income-producing assets on shore, and how is that base eroding? That's actually the opposite of base eroding, it would seem. Okay, there's one further counter-argument, though, that I would suggest, and that is if you go back to the paradigms, interest and royalties, those presumably are being paid for something, right? The interest is being paid for money lent. The royalty is being paid for use of an intangible. And the intangible, or the money that was lent, is presumably also, like the equipment that might be purchased, income producing in the US. And so it seems there are arguments that can be made, but we certainly do get to some counterintuitive results when we take this to its perhaps unlimited logical conclusion. So let's talk about another one. And as I said, the proposed regs under the BEAT, which came out a couple of months ago, do cover both these non-recognition transactions and, as a sort of separate kind of case, a taxable purchase of an asset regardless of what the consideration is. So if it's an issuance of stock by US person to foreign related person to buy a depreciable asset, that's covered under the proposed regs. The proposed regs also saw another corollary to the basic rules, which is this. Let's say the US person owns an asset, and that asset has a built-in loss. Basis is higher than value. And now the US person sells the asset to a foreign related person. So US person had a basis of 120 and sells it for 100 to the foreign related person. That's subject to the BEAT too. That 20 deduction, assuming it's allowed, has to be added back when you're figuring out your BEAT modified taxable income. Peter, does that sound like it makes sense to you?
No, Debbie. First, let's just set the context. This is, we're talking about sales to related parties or exchanges with related parties. So related party, we all know you can't typically recognize a loss on a 50% or greater, but BEAT covers 25% or greater. So we're talking about a sort of a different spectrum there. Once you cross that bridge, the statute, it says base erosion payment is an amount paid or accrued, ... with respect to which a deduction is allowed. Now, I say that with respect to which a deduction allowed relates to the word amount. Amount is different than what some aspect or attribute of the amount of the property that corresponds to the amount might have. So that's the first point. Second is related to that so the statutory language I think doesn't support it. Then second, just conceptually, your built-in attribute, your deferred tax asset in an accounting sense, has nothing to do with base erosion. That was within the U.S. tax system. It can be triggered within the U.S. tax system, so it has nothing to do with the fact that the property you're happen to use has that. The third thing is, we all of us here acknowledge that you can pay with property in a sort of a barter type transaction, and you shouldn't get out of the regime just because you used property. But the fact that you satisfied a monetary obligation with property has nothing to do with whether there's a loss or a gain in the property you're using. And I had this question come up in practice in connection with a bad debt deduction of all things, or a worthless stock deduction rather. So, am I exchanging the stock and taking a deduction with respect to the stock, and et cetera, et cetera. So I had to beat that down.
I mean, is there any argument that the BEAT maybe looks a little more broadly and is suspicious about the intercompany pricing so that when the 100 is paid, it's not maybe because this is a payment between related parties, maybe it really is 120, and so there isn't a loss, and so it is within the ambit of what they're trying to get at?
Yeah, I mean, my own reaction is that conceptually that's a different issue, and it's not a justification for you might have a little bit of dispute at the margins, but it's not a justification for the basic concept. Yeah.
I mean, you're saying that this loss on the outbound sale of property is not analogous to the classic base eroding payments, interest and royalty, because the deduction, if you will, is not the amount of the outbound payment, or the asset that's delivered is worth 100, and the loss in question, in my example, is 20. So you're saying it's not analogous, and I'm just raising possible, and you're also saying that the statutory language doesn't support it, but I mean, they may have had in mind the idea that BEAT can be broader. That said, I mean, this is an aspect of the proposed regs that has been very heavily criticized.
Not here, but.
Well, and interestingly, right, it's actually not even part of the proposed regulations. The proposed regulations, when they define what's a base erosion payment, make no mention of losses on property transfers. There is one sentence that is added to the preamble that suggests losses on these property transfers would be included within a base erosion payment. But again, I'm with Peter that the statute doesn't seem to cover it. And since the reg is parodying the statute, it's kind of an interesting question of where one ends up today in light of the preamble. Although obviously this is on the long list of things that the government may clarify one way or the other when they finalize regs.
So switching now to the rate. The rate for the BEAT is 10%, but the statute says they sort of want to give you a little time to ramp up, and so they say it's 5% for tax years beginning in calendar year 2018. So that sounds pretty clear, but the proposed regs don't in fact reach that result. Peter, how can that be?
Yeah, how can it be? That is the question.
Not the only person asking how can that be?
I should say, for calendar year taxpayers, that there's no controversy. But for this is a question about fiscal year taxpayers. So if you have a year beginning in 2018 but not on January 1, do you get 5% for your entire fiscal year or only for a portion?
Yeah. So they're referring back to Section 15 of the code, and that's got the basic provisions. Section 15A basically says if you state an effective date, that's the effective date, and in that context, if that's within the middle of a fiscal year's year, you blend. There's no doubt about that. And then Congress had a habit of writing statutes that would say beginning after, or beginning on or after, or ending after. And so 15C, subsection C was added to say those things also result in a blended rate for a fiscal year taxpayer. But the statute 59 Cap A, the BEAT statute, doesn't either state an effective date with this 10%, 5% flip, and it doesn't use those magical words. So what it says is 10% paren or 5% for years beginning not beginning after, so it's not the magical words, beginning in 2018. So it would seem not to be covered by Section 15. And further, the reference to the way it's phrased, 10% or 5% for taxable years beginning, leads one to see a reference to a year, a full year is built into that provision. And on top of that, the conference report said you have a year at 5%. So the conference report itself is inconsistent with it.
That's another controversial area. Let's skip tax treaties, since I know those were covered in a prior panel, and talk about whether this statute can be fixed. Michael, how would you fix the BEAT if you could?
Yeah, well, I think it's an interesting question. If you go back to the panel earlier today where they're talking about are the new rules better or worse than the old rules, and one of the arguments was, well, these rules are at least in place and we can fix them. And I think the BEAT presents a much more challenging question maybe than guilty or other things of can it be fixed. I mean, there are some simple things and some of these things that they can already do in regs and some of them they've already done in regs, right? There's exceptions for TLAC securities. There's a recognition that if you make a payment and it's ECI and so you're paying 21% tax on it, that we don't need to subject that to the BEAT as well. So they've already made some changes that have improved it. We're going to have some final regs that hopefully will make even more changes, although there's a lot of competing complaints with limited bandwidth to fix things, so we'll see where that goes. But even beyond regulatory changes, if you change the statute, are there things you can do? The biggest, most obvious to me is the foreign tax credit disallowance, which doesn't seem connected to anything and disproportionately hits U.S. multinationals. That would seem to need to go. The 3% threshold doesn't make a lot of sense, or it's clearly too small, in my opinion, at least should be raised. So there are pieces like that that could be fixed that it will at least make it better. Principal structures we've talked about. I think they could fix U.S. principal structures via regs, and that might take a lot of pressure out of it. But even with all those things, I still think there's a real fundamental question of whether you can have a tax, an income tax of sorts, as that's what it's phrased as, that in fact isn't on income but is on gross income. And is it something that at some level is just hopelessly flawed and that at some point needs to be, repealed? And I think it's hard to know until we see what corrections come out and see how it's operating. But I think there's a real question that's going to be out there in addition to some of the other things that people have talked about, interaction with treaties and other things like that that make it in peril. But I think the jury's still out on this question.
I just say that it seems to offend every policy we can think of, including simplicity and in the sense of having taxpayers comply. Because you have a statute that requires, everybody's out there saying, oh, COGS, well, I'm a service company. I better change industries. But COGS, I can change my accounting methods. I can do this. There's an unending amount of planning going on in the R&D space and other accounting method areas and in intermediary planning that is worthless, wasted exercise. I mean, this is called deadweight economics or whatever they call it. But
worst tax planning that's out there.
Yeah, it's just and at the end of the day, it's not going to raise that much money. Then how's it going to interact with whatever's going on with the OECD, with Pillar 2, which one of the alternatives would be to disallow deduction for a payment to a low tax jurisdiction, which has some, you're disallowing a deduction. It has a little bit of resonance with what they were trying to get at here, perhaps, and maybe, but maybe there will be a revisiting.
Yeah. Okay, so let's move on to FDII now that we've really gotten depressed. Okay, so FDII is a deduction under Section 250 for foreign-derived intangible income. It's meant to complement GILTI, the taxation of GILTI. The bad news is that GILTI, which is certain type of income earned by a CFC, is taxable. It wasn't before. But the good news is that GILTI is taxable at a lower rate than the normal 21% corporate income tax rate. And so the FDII deduction, so GILTI standing alone would encourage you to earn so-called intangible-based income through a CFC. And the FDII deduction is meant to offset that, to put you on an equal playing field in terms of earning income from your intangibles onshore. And it does this by giving you a deduction, so essentially a lower rate, for so-called income from your intangibles, which is foreign derived, meaning in the case of a sale, it's something that's sold to a foreign person for a foreign use, or in the case of a service, it's a service provided to a foreign person or with respect to property outside the US. So very quickly, how does it work? The way that the deduction is calculated is you start with your gross income, start with everything, okay? You exclude certain things. So it's basically everything with certain exclusions is a concept called DEI, deduction eligible income. But we're only trying to isolate income from intangibles. So they start with this everything number, make certain exclusions, and then they deduct a deemed return on your tangible assets. The deemed return is 10% of something called QBI, which is essentially your basis in tangible assets. So they take everything, make certain exclusions, and then deduct this deemed return on tangibles, which should leave you with your deemed return on intangibles, and that's DII. But we're not done because we want to find out what's foreign derived. So they multiply this DII by a fraction, which is essentially, the denominator is this everything number, DEI, gross income with certain exclusions, and the numerator, the F is for foreign, it's the portion of that which is from foreign sources. And I will just note that in John Samuel's speech today, he was talking about a destination-based tax system, a system where the jurisdiction that provides the market is the jurisdiction that gets to tax the income. And there's a resonance of that here, namely that the US is ceding the right to tax. It's giving you a deduction if the market, the use, is abroad. So there's a resonance of what John was talking about. So Peter, who's helped and who's not helped, and what's the policy behind all this?
Okay, I'll start on this, and then Michael can chip in. Obviously, the fact that it's keyed off of a Section 250 deduction, just like GILTI, means you need to have taxable income to take advantage of it. Not all companies have taxable income, and certain industries there particularly have problems in that regard. Plus, startups don't, et cetera. So it's not, in a sense, it's not a very efficient, uniform system. It sort of is a little bit chaotic as to how it benefits. And of course, the financial services industry is carved out completely. In terms of policy, it's sort of an interesting thing. I actually believe them when they say they conceived it as a counterweight to the offshore regime. Now, we always, in that sense, maybe we always should have had it because the offshore regime was actually more favorable in some senses before than it is now. But in any event, it was brought in at this point. And I think it was an interesting argument for the WTO to chew on, in addition to the fact that it's not just targeted to exports, since it covers a much broader range of things. A sort of bizarre thing to me, or I don't know, bizarre, but it does encourage, and in my mind, it encourages base erosion offshore. So in other words, if I'm a U.S. company and I can be taxed at 13% or 13.125% on the payments, I'm going to encourage a lot of my foreign affiliates to ramp up a little bit their royalty payments and their management fees and so forth. I think the other thing about it is that if I get a lower tax rate on selling offshore, I, in theory, am willing to accept a lower price from my foreign buyers. So in a sense, it's giving foreign buyers a pricing advantage over U.S. buyers, in theory at least. I guess the last thing I mentioned is that it's only relevant for corporates, but on the other hand, pass-through entities have a Section 199 Cap A deduction. Anything else?
I think for me, the only thing I would highlight, although there's a lot to be said, is that loss piece. The idea that companies losing money don't get this benefit. That by itself makes it odd, but it also is important because that's a feature that sort of is pervasive throughout many of these regimes. And it's not just in this one place, but other aspects of it, the guilty deduction, the inability to take foreign tax credits across periods, which means if you lose money 1 year, those benefits are gone. And one, it's a very, at a micro level, an important thing for companies to be thinking about when they're losing money. They may actually end up with a much worse tax result as opposed to normally a better one. But also when you start to think systemically across the entire economy, if things start to slow down, tax is in some ways going to start cutting into that recovery in a way that it historically did the opposite. Anyway, so that's...
Okay. Peter, do you want to say a few words about what it means to be foreign in the case of or foreign derived in the case of a sale of property and foreign derived in the case of a sale of services?
Yeah, well, the statute basically says for sales it's got to be sold for foreign use and sold to a foreign person. I think, and that's for property. Before we even get to that, you might just step back and say, well, sometimes how do you determine whether something's property or service? Because we have a lot of mixed assets, and also there are separate rules for intangible property versus tangible property in terms of whether it's foreign. And the regs have a sort of an interesting predominant use test, basically, on whether it's a sale versus a service, but that in their comments, they seem to, the Treasury and IRS officials seem to be suggesting that that same concept applies also for whether it's tangible or intangible. And so they're using examples like, in the Section 199 area, which some of these concepts derive from, we were used to saying a disk with software is a tangible property. Here it's intangible property. It seems to be the predominant character is intangible, and a cell phone, the predominant character, even though it's got a lot of IP in it, seems to be tangible property, a sale, not a service, et cetera.
So what counts as tangible versus intangible? What counts as property versus a service? These things fade into each other?
Yeah, and I was told that there was some distrust about transfer pricing involved, and so they don't like slicing and dicing in general. You see that with the attacks on low-risk distributors, et cetera, but it plays into this. You want to get to the
yeah.
This
sorry, do you
slide? No, the next. Yeah, the next one. No, the one right before this, I think. Yeah, yeah. So this slide really nicely illustrates this. You're making that foreign person versus foreign use. You got to prove both of those. You got to document both of those out, and the documentation's a big issue. There's a sort of a de minimis exception for sales in the whole year to a customer of 5,000 or less, and another one for the size of the party. And then you get then you have to decide whether it's tangible property or general property, and general property you have to basically show that it's used 3 years offshore or that it's processed further. And then, so what do you do? How do you show it's 3 years offshore? And is it really 3 years? Well, the regs also say you just have to show it by the time you do your FDII filing. So basically, 3 years becomes whatever it is, 18 months or some period of time like that. What do you have to do to diligence? It says you can't have reason to know it's going to come back to the U.S. So what do? We think about this in terms of contracts. You have to put something in the contract. They do suggest you put something in the contract. A binding contract would do it. But do customers really want to commit? It's very hard to go through the supply chain and tell everybody you can't sell things unless you get your...
Well, speaking of which, let's talk about round tripping and related parties. So you were starting to say that one of the rules, even if you're selling to an unrelated person, is this idea that the property can't come back to the U.S. But are there special rules regarding a U.S. person selling property to a foreign-related person, dealing with the concern that that foreign-related person may sell the property, or the service for that matter, back into the United States.
Yeah, so for unrelated parties, it's simply they're relying on that 3-year rule I talked about, or if you process it, there's a rule that less than 20% can be used. I might just follow up on that example. If you have a chip manufacturer and it's selling offshore to some Chinese computer manufacturer that we all know bought the IBM computer software, computer business, laptop business, how is that chip manufacturer supposed to know whether more than 20% of the value of the resale is attributable to that person's chip? Is that manufacturer in China going to represent under damages that it is? He's effectively disclosing what its pricing policy is going to be, et cetera. So there's huge problems that way. And also just in terms of proving out, I mean, if you have services, and these round-tripping rules cover services too, are you supposed to use statistical methods? I mean, if I'm selling services to a consumer, how do I can't rely just on the email address, unless I'm a small business, in which case I'm allowed to rely on that sort of thing. But do I have to use sampling, statistical analysis, or what? And if I'm a business, it's almost just as hard. If it's downloaded or if it's digital sales, that's easier to show. But if it's really software as a service, business to business, it's very difficult and gets into the relationships. So if you're with a related party, though, on top of that, then you do have these special rules that the related party has to, and it's got to be a foreign related party, by the way. You can never get FDII if you're selling to a related U.S. party. It's up to the U.S. related party to get FDII. So I sell to a foreign related party. It's got to on-sell within a year, or if there's another rule if it could show with reasonable accuracy that that eventually 80% of it's going to be sold to third parties. So, people have talked about, we should sell on a consignments because we know that then when title passes, it'll pass right before they're going to sell, and that'll be within a year, and we can deal with it that way. But you do run into those problems. And if we go to the next slide, services is a little bit more interesting. So for round tripping, they have a special services rule. So this is saying general services it's only for business services, this round tripping rule. Provided to a business recipient, yeah, I provided, is it a related business recipient? Yeah, it's my CFC. And is that person then using the service to provide a service back to the U.S.? The statute said, if that person uses a service, provides a service back to the U.S., you're just dead. We all thought, oh my God, $1 of service provided back. But the regs here are actually very rational, very benign. They're well thought out, but impossible to administer, I think. Because they say, we got 2 tests. There's a benefit test, and then there's a price test. If you flunk the benefit test, you're out. If you flunk the price test, it's a rateable. What is the benefit test? It's basically you got to show that 60%, I think it's 60%, or if 60% or more of the benefit of the U.S. to foreign service, that the underlying service, if 60% or more of that goes back to the U.S. in the final service, is for the benefit of a party in the U.S. in the final service, then you're out. But how do you really measure that? It's as I said, once you get into some of these industries, it's very hard to measure.
Okay. So now I want to go back to this basic idea of DEI. Remember, we said the starting point is all of your gross income with certain exclusions. And one of the exclusions is foreign branch income. So, Michael, why is foreign branch income not eligible for the FDII deduction? It's defined, I guess foreign branch income is defined by reference to the foreign tax credit regulations that have a concept of foreign branch income, and yet the FDII proposed regs shift that a little bit, so it's not exactly the same as the 904 concept of foreign branch income. So what's going on here with the foreign branches?
Yeah, I would say a few things, although there's a lot here for people to dig into. First of all, I think maybe it was drafting convenience or whatever, you have a provision that's doing two very different things. One, for foreign tax credit purposes, you have this separate basket, which I think was largely being done because they're worried about people putting high tax operations and branches to sidestep guilty. And here you have a rule that's really trying to carve out of what is these U.S. manufacturing and service activities to foreign customers, to limit that to activity that's really taking place in the United States. There is some vague overlap between those two provisions, but they basically created the exact same statutory framework to achieve both of those ends. And so now, as they've drafted regulations, it's, I think, created a problem for the government because they're trying to solve both of those problems simultaneously in defining what the right basket is as well as what should qualify for the benefits. And this is one place where they get into hard questions like, what do we think should be entitled to receive cross-crediting when it's a sale of an asset, especially if you sell like a disregarded entity, that's income that may not be subject to foreign tax. So you might feel differently about allowing people to put that in a basket than you might feel about whether a sale of a foreign asset is really income that should be producing FDII income. But again, it's a dichotomy, and it's something really where everybody sort of needs to dig in because there are a lot of rules that are in the foreign branch basket regulations. A lot of them deal with disregarded transactions and such, and there's some unexpected results, and it's really worth digging in. And you know, the simple one, which I'll put there, is there's a rule that says if you move an intangible back from your branch into the U.S., we're going to apply the same rules that we would if you took an intangible and moved it outside the U.S. under the 367 rules. Well, the way that works is effectively you leave all that income offshore because the whole point of the 367 rules were to tax all that income where the intangible is created. But it's another place where bringing intangibles back onshore is virtually impossible to do as a practical matter. And so again, somewhat at odds with all these policies. But again, buried into these foreign tax credit rules are some very significant implications on what's going on with FDII.
Mm-hmm. So I want to leave time for a question or two, but Michael, can you talk to us about whether the proposed regs under FDII fairly implement the statute?
I think it's interesting as a starting point, right? And BEAT, we're talking about the pain. Here we're just looking at fair implementation. I agree with Peter. There are parts of these rules where the government came out with pretty reasonable answers. To me, the two biggest takeaways from this are these are highly factual regulations. They're being applied across all types of business, supply chains, service providers, and that means, one, a lot of real analysis by tax groups as they try to put these in place. Two, and this is where I think there's some frustration with, at least in my mind about it, a lot of documentation to prove that you get there. And I would note, while we've got a new rule here, and so I understand the need for more proof, there have been significant tax consequences for foreign sales versus U.S. sales going all the way back to the beginning of the foreign tax credit, and yet the kind of documentation requirements that we see today have never been put in place. And so that's a real sticking point. The last thing I'd say is part of this factual and documentation, you could see where controversy in this space could really become a very significant issue as we go forward, where the government looking at, they're going to have a ton of documents, they're going to want to do something with those documents and become very factual. And I agree with Peter, there's a long history of trying to figure out if a transaction is a sale of services, and now it's a sale of an intangible or a sale of an intangible, that we're going to see, I suspect, at least a lot of activity in that space in the audit and otherwise. So.
All right, do we have a question?
With all of the provisions that we've been talking about here that have question marks on them, do you see a lot of disclosure that's going to be necessary in filing returns or from an accounting standpoint in the preparation of the provision?
I don't know, Peter, you may want to jump. I haven't seen that yet, and some may be that people are still sorting through, trying to figure out what exactly is qualifying and not qualifying. Some of this stuff turns out to be pretty factual, and so you could see where you could run into hard questions. The flip side, a lot of it becomes factual at a granular level. So I haven't seen anybody where it's been big dollars, like, you know, we have $5 billion of sales where we have a really hard question. It's I've got $40 million of sales through this supply chain in this one country. And so those kinds of things aren't really the kind of things that raise those big picture issues. But you could imagine, especially depending on how concentrated your product lines are and stuff, where some of these issues are going to present real provisioning questions. I don't know if, Peter, you're seeing any of that in your world?
They do, yeah. I don't do a lot of provisioning myself, but the firm does. And there's, as Michael was alluding to, materiality is a big saver, I think, you know, for the bigger issues, the fact that regulations are just proposed is definitely taken into account. They're not law. So if the thought is that they may, that the statute provides enough basis to take a position, that's a position that's taken if we think it's reasonable. A lot of, you know, in our internal presentations, there's lots of, you know, statements of we're more likely than not on this, we're more likely than not on this, da, 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 da. So yeah, it is an issue. There are, I can tell you internally, we get every day, everybody is very focused on disclosures that are filed with the SEC to see what other firms are saying. So there's a lot of comparison going on.
Michael, when you were first talking in the beginning, you mentioned on a multinational sale, a lot of times it gets allocated to the U.S. because of relationships. Shouldn't we be advising people to do local-to-local invoicing as much as possible with the current rules?
There's no doubt that historically people set these up in things that made business sense, and because of the way the BEAT works, that is no longer the case. And everyone, all the companies I know are in it's hard work, literally going transaction by transaction, trying to restructure how they do business, having, rather than the US company bill a foreign customer, have them only bill for the US services, have foreign bill directly. But again, when you start to think about like a tax system that's neutral across how businesses are making decisions, the BEAT is causing businesses to make a lot of actual changes, or sort of actual changes to the way they are operating, which do not make a lot of sense at the end of the day. And I think getting back to Peter's point, may very well mean we're not even collecting a lot of money on this, but we are doing a lot of very, very small, meaningless changes. And the sad part about all this is, right, I haven't seen anybody with a silver bullet. This is just a lot of going through all of your business transactions and making small structural changes. There's no simple solution to this picture when it comes to the BEAT.
And sometimes these changes raise, as you probably are aware, other issues, primarily nexus issues. There was a reason it was set up the other way.
Well, that's true.
Believe it or
All
not.
the other problems, I mean, people have solutions to BEAT sometimes end up raising questions about permanent establishments in other jurisdictions and things like that. So there's no simple solution, you know. There's no doubt. And you know, it also puts pressure, right? All those small changes to those relationships put a lot of pressure of you solving your tax problem by going to customers and asking customers to accommodate your need. And in a world where part of what TCJ was trying to make U.S. multinationals more competitive, putting U.S. multinationals in the position of putting a lot of pressure on their customer relations is not necessarily the solution to that problem.
And there's enormous infrastructure costs, the SAP systems and everything. A lot of the work that's being done is not tax thinking or anything. It's the software people have gone off, and it takes, you know, like Michael said, it takes 6 months longer to change systems, and it's ridiculous, you know.
Okay, I think we are out of time. Thank you very much, everybody.